today we're talking about our 2024 deals and some of the best performing deals. I'm going to share them with you so we can look back, see how they've performed, and I can show you why we bought them, how I seen that value, how it was extracted on some of them that were renovators, and we're going to break it down for you. Let's recap on the last episode. If you haven't seen the 2023 deals and how they've performed over the last 2 years, make sure you check that video. My editor will throw it on the screen and we'll put a link below. So make sure you check that video out. But I think the biggest takeaway from that was that the Australian property market over the last 2 years performed at 6.93%. as an Australian average for 2023, and the Australian property market for 2024 performed at 7.53%. Now, we have averaged out all of our purchases for 2023, all of them, at 28%. It's literally 4 times the Australian average. We've outperformed the Australian average by 4%. Obviously, I don't guarantee that on a year-to-year basis. There's a reason why we outperform, and I'm going to share it with you in this episode again. The Brisbane property market in 2023 performed at 13.3%, according to CoreLogic, and in 2024 performed at 12.2%, according to PropTrack. So the Brisbane market has performed at 31% over the last 2 years, but we're averaging 28% per annum. So we're just about doubling the Brisbane average. So our clients, we're outperforming not only the Australian average by 4 times, but we're just about doubling the Brisbane average. And how can you double or get twice as much capital growth out of the same city? Well, it's quite simple. We know what assets to buy that the market wants. We know what's going to perform because we're looking for value. This is what I've honed my skills over 20 years, looking for value, 12 years as a buyer's agent. I built my portfolio based on value, and all I look for is value. And when you layer supply-demand data with good fundamentals, strong interstate migration, good economy, and within that area, you now use your local experience and knowledge to understand market sentiment, what's going on the ground. And you layer all of that upon layer with the experience. This is how you just about double the average for that city. And 4x, the Australian market average. That's what we do. We look for value, we look for opportunity, we know how to spot it. The goal there is to buy properties that are going to perform for our clients over the years. And when we can add that sweetener, like I spoke about, and we can get that under market value deal, and you make 30K or 50K on the way in, that just adds to that just compounds. It's not all about just stealing a deal. Whilst we love that, don't get me wrong, we love that, and that's why we love the off-market deals and so on, right? But the fact is, buying a good quality asset that we can hold over the long term and really see that through multiple market cycles perform really well, that's the goal. But right now when you're selecting your assets, learn how to select assets where you can see the value and you can see how it's going to jump. And this is something that takes experience. I'm going to try and share some of that with you all today in this episode, how we 4x the Australian average and double the Brisbane average. Let's go. Okay, so 2024 was a big year for Pinnacle. It was our biggest year in our history and only surpassed by 2025, which has been an absolutely cracking year. But in 2024, that was the year we went to Melbourne for those clients who already had significant Brisbane exposure, Queensland, multiple properties around Australia that were looking to diversify. Melbourne was it was by me being talked about in February 2024. And we were getting in early and buying some great deals, and a lot of them under market value as well. And Melbourne just struggled to take off and perform at the level that Southeast Queensland has and at the level that Perth has. And interstate migration is the big key factor here. Affordability, strong wages, good economy, and interstate migration has really pushed Brisbane and Perth. And that's why you're seeing those averages right now. When you have a look at the latest data reports from Cotality, you'll notice that they're the best performing cities, right? And they're beating Sydney and Melbourne on a month-to-month basis. Now, Melbourne's still kicking off, but Brisbane has continued. Southeast Queensland continues to perform strongly. And the assets that I want to talk about vary. So we have some that we've bought just because they're the right asset in the right market. That is a set and forget type of property, minimal maintenance, and there's some that have been renovators. And there's no surprises. Those who do value adds through renovations end up getting the best results, and I'm going to share that now. So first up on the list, I think it was January or February 2024, we picked up a property at 16 Knight Avenue in Silkstone. This is in Ipswich. We paid $495,000. It's on an 800 plus square meter block of land, huge block of land, and it's a double brick house, and it's huge, right? It's got the double garage, and it's got like a double carport, and then it's got a bunch of rooms downstairs, and then 3 bedrooms upstairs, and it's just a good quality build. It's not that typical cheap, high-set Queensland style of home. I'm not referring to the Queensland, I'm referring to the cheapy, Logan, or they're everywhere around Queensland, but that cheap build of high set. Now, this particular property had a renovation done to it, had a new bathroom, new kitchen, flooring was done, paint was done, and it came up immaculate. If you have a look at these photos, it's been done really well. Now, that property's worth approximately $850,000 today. Now, $850,000 today, it's December 2025. This was purchased at the start of 2024. That's a 71.7% uplift, or 35% per annum, right? The Brisbane average is what, 13% over the last 2 years, each year in capital growth. We've got 35% per annum over the last 2 years for a total of 71% capital growth. Now, this was achieved through a variety of factors. Once again, supply demand is great. All of that aligns. Interstate migration is strong, and Queensland continues to power ahead. But the affordability factor. I mean, we bought this under market value to start with. Okay, so the under market value to start with, plus the equity uplift, the market's been, performing strongly. This is a quality home. This asset has owner-occupier appeal, as well as it's a good investment property. This one was purchased for Alex. If you remember Alex, he was in our Sparky episode, the Sparky with the $5 million portfolio. That's one of his purchases, and he organised the renovations on that. And yeah, that property, has had the benefit of the growth over the last 2 years, and that quite accelerated growth over the last 3 months as that first home buyer scheme has been announced. It's probably jumped another 100K in those 3 months. So that's a very, very solidly performing property over the last 2 years, and it's just, it's done really well for him. Another one is Scarborough Street, Southport. Now, this one we paid $385,000 for. This is for a Sydney client. This is their first property in Australia. They've migrated from Italy, and they paid $385,000 for it, and there were properties going for low to mid fours. So we've picked this up for $385,000. They've done a kitchenette and I think some floorboards in the property, and it's worth $600,000 today. There's been a $580,000 comparable recently, and there's no doubt in my mind that this is a $600K property, especially with the renovations. That's an equity uplift of 55%, or $215,000 on that, which gives them a deposit to buy another property. 26.5% per annum capital growth over the last 2 years. Solid performing, and that's a two-bedroom unit. 2-bedroom or 1-bedroom? We'll have to double check that. I see so many properties. That is an amazing result. Now, why did we buy that one? We don't buy units in high rises. So your typical, for lack of, and I'm not taking the piss out of Meriton here, but your Meriton type high rise, like there's 60 level high rises here in Brisbane. Those, from an investor perspective, if you're buying, right, for Meriton, that suits their business model. As an investor, for you looking to scale a portfolio, you wouldn't be looking to buy those type of assets. If you're going to buy a unit because you want location, because let's face it, if you're on the Gold Coast, it's hard to buy a house for $385,000 even in 2023. So you buy a unit. But the way in which you buy it, you need to look for the smaller complexes, the complexes that don't have a lift, the complexes that are, the three-story walk-up. There's not a lot in the complex. You've got a larger land component attached to it. So if you think about it, if you've got a 60-story building that's built on 2,000 square meters, I'm just throwing out numbers here. So if you're a project manager or you're a construction guy, go easy on me. But the point I'm trying to make is if there's that many units, you wouldn't get a 50-cent piece of, oh, geez, I just did that too, didn't I? You wouldn't get a 50-cent piece of land, right, in, attached to your title. Whereas when you go buy, like, let's say a block of 10, you buy a 1-bedroom unit in a block of 10 at surface, just behind where all the high rises are, you can actually buy one unit in a block of 10 that's on 2,000 square meters or 1,500 square meters, which technically you've got attached to your title 150 square meters of land, and you've got a one-bedroom unit that has been rezoned to put high rises on. So that is the better value. And I've talked about this in previous videos, and that's a good one. So that's what we look for. And with this particular one, that's what we've done. We've looked for the smaller complex, under market value, the potential to add some value. They've done that. The market's taken off as well. It's done really, really well over the last couple of years. And that little bit of a bump now at the end of 2025 with the first homeowners grant has produced some amazing results for them. They can refinance, buy again. Now, another purchase that we picked up was in Warnbro in Perth, right? So it's just south of Perth, probably, I think it's 40 minutes off the top of my head. That's a 422 on a 600 plus square meter block of land. We paid 519K. Now, this was under market value already, because I think she got a valuation back at 575 straight away. So under market value, but it was in a market which has performed really well. Low supply, high demand, a lot of interstate migration. There's literally no stock in Perth. Rents have skyrocketed, right, since 2022. So it's performed really, really well. And that's now worth $800,000. So there's just under $300,000 there of equity for our client, or a 54% equity uplift over 2 years, right? So 27%. 27% capital growth per annum over the last 2 years for that, right? Once again, we spoke about that. The Australian average, 7%? That's 4xing once again, right? Not 4xing the beer, 4 times the capital growth that the Australian property market averages. So fantastic result. That's just a set and forget, rent it out, nothing to do. That's a good one. Now, we know that I've spoken about the townhouses, and townhouses have performed really well, and we know that. Now, we've picked up one in Castle Hill Drive in Murrumba Downs for $500,000. Now, $500,000 was a little bit cheap. It was on the cheaper end, let's face it. It was under market value, but Murrumba Downs is, for those who don't know, it is next to Griffin, which is just under North Lakes. So it's on the north side of Brisbane, just on the other side of the Pine River. And it's right on that on-ramp to the highway. It's ease of access to Brisbane and close to Chermside, close to North Lakes. It's in a good spot. So I really, really like its location. I know that these particular Philip Usher builds that are all built roughly around 2010, you'll find a heap of these complexes around Brisbane. They're a decent build and they don't have many issues, and they're relatively new still, right? So buying this type of an asset where houses have already skyrocketed, that you can see that gap in the market, and just jumping in, pouncing, getting a little bit under market value is that sweetener. But knowing that construction costs have risen and that the house prices have surged. So these are very tightly held, because a lot of these complexes have property managers in there that just lease to investors. So for the locals trying to buy this sort of stock is actually quite hard, and they only come up every now and then, and they always sell for over, and we tend to buy them under value, right? Which is a win for our clients, but it's not just the initial instant gratification under market value that we look for, but it's that long-term growth, and townhouses have provided it in spades with that particular property. Now it's gone up from $500K purchase price to $760,000 as of December 2025, which is a 52% equity uplift in 2 years. So 26% per annum capital growth if you average it out over the last 2 years. So yeah, doubled the Brisbane average. Fantastic result once again. It's a set and forget type of property. You don't have to work on it. You rent it out, minimal maintenance. It's just a simple, easy, clean buy, and that's a fantastic result. That's from Tony. He got divorced and started again from scratch. And we put him into that one. We also bought him another one, and he's doing really, really well. So that's a great result. Now, 12 Stanley Street, Gympie. This is another one. You might have seen this on our Instagram. If you've been following us for a little while, it was the Gympie renovation on the northern end of the sunny coast, $415K. That's now worth $800,000. That renovation was quite expensive, and getting trades there was difficult, and it was an expensive renovation which cost in excess of $100,000, even though it had quite a fair few of the parts as already provided. So that has an equity uplift from $415K to $800,000, or a 92% uplift there, 92% uplift. Like that's crazy. That's just under 100%. But obviously there was $100K spend on that for that. And that property had, 3-4 months of no rent whilst that renovation was completed. So there is an expense there in order to have those sorts of figures, right? Outperforming the market, and that outperformed the market by nearly double what a lot of our other purchases were in terms of percentage equity uplift, but you had to work for that, and that was renovated, and there's a lot of headaches associated with that. So look, still a great result for Nick. Look, and he's happy with that. He's got that tenanted now, I think, for $650 a week, $415K purchase price, $100K reno, rented for $650 or whatever it is, $670. Not too bad. The other one was the cheap one that we bought on the Sunny Coast. You might remember this from Instagram as well, and it was $420,000. This one, I think, from memory, and there is a video on Insta, I think it was a $60K. Freshen up, the kitchen was kept, the bathroom was kept, and yeah, that's now worth $900,000. That's 114.2% equity uplift in the last, I think, maybe year and a half, because it's a 2024 purchase. So yeah, that is a ridiculous result. Now, what's the key theme here compared to the set and forgets? The set and forgets here, on my sheet, I'm reading from the sheet in front of me, 55%, 54% over the last 2 years, 52%, right? 43% over the last 2 years. They're all the ones that are set and forget. The ones that are renovators are 114% over the last 2 years, 92% equity uplift over the last 2 years, 71% equity uplift over the last 2 years. The three best performing, what they all have in common is renovations. Is buying something that is absolutely in a shocking state, putting in the sweat equity, renovating it, spending your time, effort, money, tears, getting ripped. Some tradies, have done some wrong things on some of those, and it's just taken some time to complete some of those. But there's a whole bunch of issues that happen or occur during a renovation. It's never absolutely smooth sailing, and if it is, you probably pay too much. But in regards to, they're the best performing ones. They're the renovators, right? But standard type of set and forget, we've still outperformed the Australian average by 4 times, and the Brisbane average pretty much doubled the Brisbane average. But yeah, when it comes to buying those renovators, yeah, it's like 8x. So, it's absolutely crazy what some of these property prices have, how much equity, it's produced. So, okay, so what I want to leave you with is the fact that not only do we outperform the averages, it's about buying the right asset that represents value for money in that market, and where there's a discrepancy in the numbers. So house prices have risen a great deal, and townhouses are now picking up, and units have performed really well and outperformed houses over the last few years in Brisbane in particular. And that's because people will take whatever they can get at the end of a cycle just to get in based on affordability. Whether you're an investor and you have minimal serviceability, or you're an owner-occupier. If you're an owner-occupier, everyone's going to choose the premium waterfront home first. They're going to choose a home first. They're going to choose a house with land first. Then they're going to choose the townhouse. Then they're going to choose the 2-bedroom unit, and then the 1-bedroom unit, and so on, right? So the more desirable properties are usually the first to kick off during a property boom, and they're the ones that everyone wants. They're the ones everyone prefers, and they're the ones that perform first in a property cycle. And it's up to you to select based on affordability, and being a property investor, looking for that good yield, where that next asset is in line for its capital growth. Spotting that, buying it under market value if you can, that's the sweetener. But in general, it's buying that right asset at the right time. And they say you can't time a market, but I tell you what, you can get pretty bloody close. I don't want to ever guarantee it because it's on camera, but I'm telling you, when you know what you're doing, it's like shooting fish in a barrel, and it's obvious, Spotting value for money is something that we see before others see it, and we can see how the market's reacting and what they're going to look at next. And I think that's the key. That's the difference. And the real reason you should be hiring a buyer's agent, especially a good one, is to be able to foresee these things so that you can outperform, because anyone can just go out and buy an investment property. Anyone can just buy a property anywhere in Australia, and over the last 2 years, it's gone up 7.8% or 7.9% or whatever it was, 7.53% in 2024 went up. But you want to beat the averages. You want to know where to buy. You want to know how to analyze the data. You want to know how to buy the right asset in that spot. So it's not just the analyzing of the data, it's the asset selection. It's like buying value. trying to buy it under market if you can. Try and buy something that can add a bit of value. With just cosmetic renovation, doesn't have to be fancy, doesn't have to be a whole adding a bathroom and adding a bedroom, right? But the key is to use a good buyer's agent and outperform the market. And as you can see, averaging out, we've outperformed the Brisbane property market, but just about double and 4 times the Australian average price growth. Now, is that going to happen next year and the year after and the year after? Look, there's a good chance, I'm telling you, we're going to outperform the averages in general. Is it going to be to that standard or to that level? I don't know, but I promise you, we're going to outperform it. And that's what we do. And that's the difference when you use a good buyer's agent. I really hope you got a lot out of today. But I also want you to throw something in the comments if you have a question, but you can get in touch with me. If you have any questions and you want me to break down any of these deals, I'm happy to jump on a Zoom call, share my screen, and we can discuss these deals. We can discuss across the 2023 and 2024 podcasts if you watch them. Any questions, I'm more than happy to chat. But listen, I hope you all have a good holidays, and I really appreciate you watching our content. Please like, share, subscribe. I'll see you all in 2026. Take care.